You're sitting on some cash right now. Maybe it's 500, maybe it's 5000, and you're asking yourself, do I park this in a high-yield savings account, or do I throw it into the market and let it grow? Make the wrong call, and you could be leaving thousands of dollars on the table. Make the right one, and you're building real wealth on autopilot. Today, breaking down exactly where your money should go, and the answer might surprise you. Welcome to Cash Flow Hacks, the channel where we make your money work harder than you do. If you're new here, hit that subscribe button right now, because every week we drop videos that put more cash in your pocket. Alright, let's get into it. Step 1. Understand what a high-yield savings account actually is. Most Americans still have their money sitting in a traditional bank savings account earning a pathetic 0.4% interest. That means if you have $10,000 in there, you're making about $40 a year. That's not even a Chipotle burrito every month. But a high-yield savings account in HYSA is a completely different animal. Right now, in 2026, the best HYSAs are paying up to 4.2% APY with no monthly fees and no minimum balance requirements. So that same $10,000, you're now looking at $420 a year, fully liquid, fully safe, zero risk. Online banks can offer these higher rates because they don't have physical branches, no rent, no tellers, no overhead, and they pass those savings directly to you as higher interest. And here's the best part. Almost all of these accounts are FDIC insured up to $250,000, so your cash doesn't lose value and it's protected. Sophie, Ally, Marcus by Goldman Sachs, American Express Savings. These are all solid options right now, and HYSA is not an investment. It's a supercharged parking spot for your cash. NerdWallet Plus 2 Step 2. Understand what investing actually means for your money. Now on the other side of the ring, we have investing. And when I say investing, talking about putting your money into assets, S&P 500 index funds, ETFs, stocks, real estate, things that grow in value over time. Over the past 10 years, the S&P 500 has delivered an average annual return of around 12.39%. Let that sink in. Your HYSA gives you 4%. The stock market historically gives you over 12%. So if you put $10,000 in an index fund and left it alone for 20 years, at that average return, you'd end up with over $96,000. The same $10,000 in an HYSA at 4% over 20 years, around $21,000. That is a $75,000 difference from the same starting amount. That is the power of investing. And this is a big, but the market goes up and it goes down. In 2022, the S&P 500 dropped over 19%. If you needed that money during that year, you were in trouble. That's the risk. And this is exactly where most people get confused. US News and World Report. Step 3. Know which one is right for your situation. Here's the real answer that nobody talks about. It's not either or, it's both. But timing and purpose matter everything. Let me break it down. Simply, use a high-yield savings account for your emergency fund. 3 to 6 months of living expenses, sitting in a safe, liquid account earning 4% plus. For emergency funds, liquidity and reliability matter more than chasing the top rate. This is your financial safety net. It should never be in the stock market, because the market doesn't care that your car broke down. Use an HYSA for any money you need within the next 1 to 3 years. A down payment on a house, a vacation fund, a new car. Short-term goals need safety and access. If your HYSA earns 4%, but inflation is running at 6%, you're technically losing purchasing power, but your balance is still growing and your money is protected. So for short-term goals, an HYSA wins every time. Green thick no money you won't need for 5 years or more. That goes into the market. Every single dollar you leave sitting in savings long-term is a dollar being slowly eaten by inflation and missing out on compounding growth. Your retirement savings, your wealth-building money, your I want to be financially free in 15 years, money that belongs in index funds, ETFs, and diversified investments. Time in the market beats timing the market. Every time. Step 4. Build the perfect money split. Here's the exact framework I recommend. First, build your emergency fund in an HYSA, 3 to 6 months of expenses, locked and loaded. Second, if you have short-term savings goals within 3 years, keep that money in your HYSA too. Third, every extra dollar beyond that, invest it. Max out your Roth IRA first in 2026. You can contribute up to $7,000 a year, and that money grows completely tax-free. Then put money into your employer's 401k. Especially if they match that's free money. Then open a regular brokerage account and invest in low-cost S&P 500 index funds. This framework means you always have cash available when life hits you, and your wealth is growing in the background on autopilot. Here's the bottom line. A high-yield savings account is not your path to wealth. It's your protection layer. Investing is your wealth engine. Use both. Use them for the right purpose, and you will be miles ahead of the average American who's letting $40,000 sit in a 0.4% savings account, wondering why they never get ahead. If this video gave you clarity on where to put your money, smash that like button and drop in the comments. Are you Team HYSA, Team Investing, or are you doing both? I read every single comment. Subscribe to Cashflow Hacks if you haven't already, and check out the video right here for our full breakdown on index funds and ETFs. That's your next step. I'll see you in the next one. Let's build that wealth.